This is Mike Koppel, and this is a year-end tax. This is our conference on new tax legislation to avoid the fiscal cliff. We're going to discuss a lot of good information here, things that you should have to know. It is not all-inclusive, but we cover all the major topics. Here's my picture, along with most of my contact information. We have my direct telephone number, my cell number, my office email, and my personal email. I'm generally around most of the time. Best to get me is either calling my cell or using one of my email addresses, and that will get you to me pretty frequently. Basically, what we're talking about is the new American Taxpayer Relief Act of 2012. A couple of things I want to bring up. The first is that, and those of you that have heard me speak before have seen this slide, and it's something that I'm now including in all of my presentations because I think that it is really important that people remember and understand that even though I am a tax person and I live and breathe taxes, really important here is that people understand that shouldn't be doing things exclusively for tax reasons. It was really important that we take a look at everything we do and make sure that we have a good economic reason for all of the things that we're doing. We don't do things for tax purposes. It has to make business sense as well. I have a couple things that as I was following all of this, there was quotes that came out that I thought were humorous that I thought I would share with you. The first is, thank goodness to Congress for keeping its wayward members off the roads and out of the bars on New Year's Eve. As you will know, this legislation was finally passed at 2 in the morning on New Year's Eve. I thought that was rather cute. The second is the morning after, so often happens, there are regrets. You know, what's interesting here is that when you take a look at people were saying after the passage of this legislation, basically everybody was saying, well, it's not great, it's not perfect, but at least we got something done. There are a lot of holes in this and a lot of things that we expect are going to be changing as time goes on. So I thought that was kind of interesting. The last one is kind of interesting, and it actually forced me to actually go back to the actual details of the legislation to make sure this was right, and it is indeed right. And it's kind of funny, where somebody said they scanned the entire fiscal class bill for this tax breaks, and economic development of American Samoa is one of them. Now, what points up about all the entire part of the legislation is that when we talk about taxes and we talk about various things, and we talk about loopholes being created, and we talk about pork, I don't mean to say American Samoa is pork by any stretch of the imagination, but basically within this legislation, if you bother to read the entire thing, you'll find there's lots of things that are in there specifically to help specific industries or probably even specific people, which is something that we were hoping Congress would actually stay away from. So let's talk about one thing that is not in legislation, and that's the payroll tax holiday. For the last 2 years, people had a major break, a 2% break in the amount of their payroll taxes, 2% of payroll tax, of a reduction of 2% on payroll taxes. What's interesting about this is this has gone away. It was not renewed, which was pretty much expected. People were being told that it wasn't going to be renewed. But we'll talk about something that is specifically designed to help whatever middle class is. You think that something that is putting for a family of 4 making $50,000, putting $1,000 in their pocket, right, their payroll, that's something that they should have considered renewing, but they were not renewed, and as of right now, there is no discussion whatsoever to bring it back and renew it with future legislation. So that's something that has absolutely gone by the boards, and basically is going to wind up actually causing an increase in taxes and a decrease in people's payroll take-home pay, which is kind of interesting. Now, got the most attention it increased to a 39.6% bracket. And we have in this chart the thresholds at which tax bracket will start for on taxable income. $100,000 single, $450,000 for married filing joint. Now, what is interesting here is one of the things that people were throwing around is that the marriage penalty was going to be eliminated from tax. And basically, what we see in this specific situation is that basically there is a marriage penalty here. So the two people who get married could wind up having to pay more taxes because they were married the other way. So that basically if you had two people each making $300,000, for example, basically this would force them into the 39.6% tax bracket, whereas if they filed single, they wouldn't have to. You know, this is kind of interesting, and basically as another example, almost even more examples as we go through, of being a marriage penalty, people having to pay more taxes just because they got married. One that came through, which we expected, is there's an increase in taxes for capital gains and dividends. They're no longer going to be taxed at 15%. They're going to have a base tax rate of 20%. Now, the thing you have to remember is that the threshold for when the 20% starts is going to be the same as the 39.6% tax rate. So we also actually have several different tax rates that are actually available, capital gains and dividends. Very low income people, basically 0% tax. The 15% tax is still there for everybody below the threshold, and then the 20% tax for everybody above that threshold that we had before. Now, the other thing you have to keep in mind is that when we talk about the 20% tax, that does not include the 3% new Medicare tax or other tax on top of other taxes that's going to happen during this year. So basically what we see is for high-income people, and remember that the definition of high-income people, the 3% tax, is different for the definition of high-income people for the 39.6% tax and the 20% tax. The 0.8% tax, in that case, rich people are defined as married filing joint of $250,000 of adjusted gross income, which means it's before itemized deductions and before exemptions, and then 20% and $250,000 for married filing joint. But this means if you exceed both thresholds, what you have is you have a tax rate of 23.8% on capital gains and dividends. So you have an increase compared to the 15% of almost a 60% increase in the tax rate for capital gains and dividends. One that we have been talking about, and I've been talking about specifically to some of our clients that had installment sales during last year, is that you may want to consider opting out of installment sales. So that if you have a sale of a sale of business, your sale of something else, and what you want to do is you're going to sit here and say, I want to elect out of that so that I have the lower 15% capital gain rate 2012 as opposed to the 20 or 23.8% rate in 2013. You elect out of installment sale. Now, there's a warning that we have to have, and we've talked about this in some of our other seminars. If you elect out of installment sale, and later some time goes by, you find that the people that you sold the asset to don't pay you, that's now going to come back as a capital loss. And we all know capital losses are not a good thing. Capital losses can only be used to offset capital gains over the rate of $3,000 a year. So as we're electing out of the installment sale treatment, we can be pretty sure that we're actually going to collect that note. One of the other interesting situations we have here is that when we have, for example, real estate, we have what's called recapture. unrecaptured depreciation tax. And that tax is 25%. Now that used to mean that basically the difference between your basic capital gains rate of 15% and your recapture rate of 25%, there was a capital gains rate differential there of 10%. Now it's a different situation. Basically, we now have the potential capital gains rate on sale of real estate could be as high as 23.8%, and the recapture rate may be 25%, which is only 1.2% differential. But you know, it is going to be interesting to see what happens with that, and see whether or not they eventually change the rates for recapture of depreciation. Now, and when I hear people talk, people say, well, I'm going to beat the tax rate increases for both net investment income changes and the new 20% capital gains and dividend rates by putting these assets in a trust. And basically what we have to say is trusts do not escape. However, what we also have to remember is we may have a situation where the amount of income in a trust is going to cause that to be taxed at a higher rate, at a 20 or 23% tax rate, whereas the beneficiaries of those trusts or estates could be taxed at a lower rate. So we're going to have to start taking a look at the end of the year to see whether or not it's beneficial to make distributions out of a trust in order to minimize those taxes. But just remember, when you make a distribution out of the trust, especially if you're making distributions to minors, we have to take a really close look at what happens, whether or not we want to have any kind of significant assets in the minor's name, whether or not we can put it in the minors and somehow keep the funds away from them, whether or not it's going to be somehow swept into kiddie tax, all kinds of other situations that we have to talk about as we're talking about planning for estates and trusts and minimizing their taxes in general. Good news. Every year for the last 10 or 15 years, we have heard the problem that the alternative minimum tax exemption has to be indexed again every year. What this legislation does is it permanently indexes that exemption for inflation forward as a permanent change, which is basically good, means that it is one less thing we have to worry about. It's going to happen every year anyway, but basically makes it permanent. More importantly, for a lot of our clients and a lot of business people, is that non-refundable credits can continue to be used against alternative minimum tax. So, for example, if a business has a research and development credit, if they work opportunity credits, those are non-refundable credits. If those are earned in a pass-through entity, those can pass directly down to the shareholders, stakeholders, and they can be used not only against their regular tax, but against their alternative minimum tax. This is a major, major important thing for us to help business people. It seemed a long time ago, but only 2 or 3 years ago, we have to remember that basically what was happening is that we had a gradual phase out of our itemized deductions. And we kind of forget that we had that because we had it for a couple of years. And prior to that, it was just 1% and then 2% and 3% if you go far enough back. It's come back now, and it's come back with a vengeance. So basically what we see is there is a new limitation on the amount of itemized deductions that can be used. And again, we have a new definition, another definition of what's called high-income people. In this situation, people with adjusted gross income, $300,000 for married filing joint and $250,000 for single people, they will be called rich, and that's when the phase-out of itemized deductions start. Now, what's really interesting in this case is that this doesn't affect all of your itemized deductions, only certain of your itemized deductions. So basically what we see is medical expenses, investment interest, casualty losses, and even wagering losses are excluded from this calculation and will not be phased out. While some of the things that you look at that are more common, such as your real estate taxes, your state income taxes, and even your charitable contributions will be subject to this phase-out. And that is something that is kind of interesting, especially the fact that charitable contributions will be phased out over time. Basically, what we have to remember is only 80% of those available deductions can be phased out. They're phased out at a rate of 3%, but it's 3%, once again, $250,000 and $3,000 for married filing joint. So that says is if I have someone that has $1 million of adjusted gross income, a successful, very successful small business person, they have $21,000 of those specific exemption itemized deductions be phased out and not available to them. And this is something that we're going to have to take into consideration. Now, what we're going to be looking at is, once again, this may not be a huge amount of money. It is significant enough that we're going to want to take a long, hard look, make sure that we minimize the effect of this and avoid losing our itemized deductions. And we might be talking about doing budgeting of certain itemized deductions, such as when we pay our fourth quarter state income tax estimates and when we make our contributions to charities. In addition to that, we also come back and we again have the phase out of our personal exemptions. And that phase out is the same definition of rich: $3,000 married filing jointly, $250,000 for single, and it's basically phased out at 2% for $250,000 in excess of that adjusted gross income amount. So that basically, when you stop and think about this, what we really have here is a situation where the 20% div rate or the 39.6% rate on ordinary income could actually be significantly higher than that, because we're losing our deductions and we're losing our exemptions. So we're basically inching, you have that situation in both cases, we're inching closer and closer to an effective marginal tax rate, highest tax rate, somewhere in the excess of the high 40%. Change which you have to consider, and it a few years ago, basically the change was made which allowed people to convert the traditional 401ks to Roth 401k as long as the employer offered a Roth 401k, but they're only available to people that were 70 and a half or older. Basically what this does is this says that anyone can change from a traditional 401k to a Roth 401k regardless of age. Now, whether or not converting from traditional to Roth makes sense, whether that's something you should be considering, something you should be doing, you really have to sit down with a really good financial advisor, a really good tax advisor. We here at Gregg & Gray are very lucky. We have outstanding financial advisors in our GEM department. Danny Rano, a call, and he'll be happy to help you, or talk to one of us in the tax department, and we'll be able to help you and tell you what the advantages and disadvantages of a traditional over a Roth and vice versa, and when you should be considering doing that. This is now available. One thing several people were asking about at the end of the year is whether or not they could continue to make a direct distribution from an IRA to a charity of $100,000, which meant they would not get the charitable deduction, but they also would not have to pick up the income as a distribution from their IRA. And basically what has happened here is we have done this, and the legislation does it retroactively, amazingly enough. So basically what we see is that a distribution that is made January 2013 can be treated as being made in December 31st, so that basically you still have the rest of this month if you want to take a distribution of your IRA directly to charity. You can do that this year and have it not count as income to 2013, or is it will be treated as a 2012 distribution, and it can be excluded from both income and as a charitable donation. So, you know, depending on where you are in charitable donations and where your itemized deductions may be, this is something you may want to consider. Now, it gets even more complicated. Basically, in addition to that, it also says, and I'm going to read this, it says, any portion of a distribution made in December, and that's December only, of 2012, may be treated as a qualified charitable distribution to the extent that such portion is transferred after the distribution in cash 2013 to a qualified charity, and the distribution otherwise qualifies as charitable distribution. So basically what this says is, if you took a distribution in 2012, you can take that distribution and you can take it and you can say, all right, I want to make this cash and take and give it to worthwhile charities such as the Mike and Tina Retirement Fund, and I'm only kidding, and basically that kind of not be treated as either income or as a charitable donation, and this is something, once again, you really have to sit down with your tax advisor and your financial advisor to see whether or not these things make sense to you. A number of education provisions were all extended. The American Opportunity Credit, which basically replaced the Land Learning and Hope Credit, was extended through 2017. The exclusion for business education of 5250 was made permanent. Student loan interest deduction was made permanent, and deduction for tuition and expenses was extended through 2013 and made retroactive. So all these things are in the legislation going forward. Here's some of the other things that are included there for individuals: state and local sales tax deduction, child tax credit, earned income credit, adoption credit, child and dependent care credit, teacher class, the $250 teacher classroom deduction, which is actually very important for our teachers to be able to do their jobs to the best of their ability, is in there. And some of you, this is important, and I've spoken to some people about this, is the capital gain of property to a conservation group also in there. So all of these things were all extended. There's actually very little other than what we talked about at the beginning with the payroll tax holiday, which is not included and not extended to some way or another. Notice down at the bottom, I have the surprise here, and what happened in the gift estate and generation skipping, it was truly a surprise. You know, we were afraid that the exclusion was going to drop down to $1 million. What President Obama had proposed was an exclusion of $3.5 million. And what finally happened really surprised us. What happened is they said, okay, we are going to use $5 million index for inflation, which now means that in 2013, we had a gift estate and generation skipping tax exclusion of approximately $5,250,000, which is something we never expected to happen. That one. Number two, the portability, which basically means that if one spouse does not use all their gift exclusion, that gift and estate exclusion goes over to the surviving spouse so that they can use it. So, for example, if I don't use any of my exclusion during my lifetime, it means that the wonderful Tina will have over $10 million of giving. We don't have that number of sets, but if we should happen to, the wonderful Tina will have over $10 million that she can use to gift to our kids or pass through her estate, assuming I die first. The only thing that is in there is that any amount in excess of the exclusion, instead of being taxed at 35%, is going to be taxed at 40%. The other big surprise here is that the exclusion was made permanent. And a lot of us were very concerned that some of the techniques that we use in order to minimize gift and estate tax, things like discounting, intended effective trusts, grants, and other things, we thought a lot of that was going to go away. And basically, once again, nothing happened in that area. All of these things are still available for the time being. Now, I want to caution you on something, and we'll talk about it a great deal. Permanent is a funny word in taxes, and we'll get to the definition of what permanent means a little later in the discussion. But basically, we have to, as of now, everything we saw, everything we were afraid of, did happen in the gift and estate area, and has been made permanent. Let's talk about business. Once again, we have a lot of surprises in there. The first surprise is Section 179, the ability to expense the purchase of fixed assets. And basically what we have is that the amount from 2011, $500,000 worth of assets and $2 million limit before things start getting phased out, that was made effective retroactively for 2012 and 2013. That's a huge, huge change, and one that is going to really help business. Now, my caution here, as has always been for these accelerated depreciation items, is please remember that what you're talking here is that when we talk about 179 in a couple minutes, when we talk about bonus depreciation, these are timing differences. So what we're doing is you are accelerating your deduction, all right, but going to come back in later years so that when you do this, you got to somehow make sure that you not only are taking advantage of the deduction, but you recognize that you're going to need the money to pay for this in the future, because basically you're going to have less deductions in the future when you would have had depreciation. Now, depreciation, bonus depreciation, you may remember, 100% in 2011 and 50% in 2012, and was supposed to go away entirely in 2013. And basically what they've done is they have taken the 50% bonus depreciation and say it will be in place again through 2013, and we'll see what happens later in the year to see whether or not that's going to be extended even more. But this is a really, really important situation. Basically what we now have is that for capital-intensive industries, we still have the 50% bonus depreciation, and we have the $500,000 of 179. Basically, we're going to be able to take a lot more deduction for acquisition of property, plant, and equipment than we thought we were going to in the past. And one more thing in this area, and that is that the 15-year life for restaurant, retail, and leasehold improvements, which expired at the end of 2011, now is available for 2012 and 2013. So this is really, once again, really important for a lot of our clients and a lot of people in the restaurant and retail industries, as well as people who have made leasehold improvements, that they're able to continue to use the 15-year life in 2012 and 2013. Basically, almost all of your business credits, your R&D credit, your work opportunity credit, and almost all other business credits, as well as energy credits, are extended through 2013. So we really see that in this area, almost nothing has changed. Everything is going to be pretty much as it was, and it's in place retroactively. If you're an S corporation, if you're a C corp, excuse me, if you're a C corporation and you're out there, one of the things that when I give my talk on choice of entity, I sit there and I find somebody that is a C corporation, and I say to them, why are you a C corporation? And there are very good reasons for being a C corporation. However, one of the things that we have to remember is that if you sell your assets, if in a succession plan, and you sell your assets as a C corporation, what you're going to wind up with is an enormous tax. Right off the bat, what you're going to wind up with is you're going to have, as it stands today, a 35% federal tax on the sale of your business assets, plus an additional 20% or 23.8% tax on your. So you're going to wind up with a combined tax that is probably going to be somewhere around 60% of the total gain is going to wind up going away through taxes. That's what the built-in, and then what the built-in gain tax says is you sell your assets over a certain period of time from when you elect to be out of C corporation into an S corporation, you wind up having that same tax on the assets that were sold as if you were a C corporation. And what's interesting in this situation is that Congress reduced the number of years that tax exists back to 5 years, so that basically what we're talking about is that if you are a C corporation, you can get out of the big tax for in 5 years, and it's a huge, huge differential that we're talking about. I want to talk very briefly about the repair regulations. As a lot of you that follow what we do in our blast emails and year-end seminars and so on know that the repair regulation is the regulation in order to basically change the entire way as what is capitalized and what is going to be expensed, and when you can expense certain things and so on, was supposed to take effect starting in 2012. What the IRS has done is they have postponed that effective date until the beginning of 2014. And basically what they have said is that the regulations that are currently out there that were issued in November 2011, they're going to go and they're taking another long, hard look at that. We know that there are some changes that are coming down the road. Those of us that have been involved in presenting things to the IRS in that area, know there are going to be some changes in that area. I do want to make people aware of that, especially for real estate people, number one, who have made a major change to their real estate, replaced all the windows, replaced the roof, you should be looking at whether or not it is beneficial to do early adoption of the 2012 of those repair regs. You know, it's a little complicated, but it is something we should actually talk about. You know, you can give us a call. We pretty well understand that. It's a major, major decision that you have to make. We expect that the new repair regs come out in final form probably sometime, we're told now, in the second quarter, probably late in the second quarter, late May, early June, before we actually know what's going on in this area. But it's something that you have to consider. The other thing you have to consider, and in the discussions that I'm on dealing with repair regs has talked about, is one of the other things that's really important in this area is if you believe that you made a mistake in depreciation in the past. This is another reason why you may want to do early adoption. That's something, again, you should be talking about with your tax advisors. Make sure that things are the way you want them, and move forward in that area. I just wanted to mention that very quickly. You have to remember that we still have two major portions of the fiscal cliff to worry about. Secretary of the Treasury Geithner, has indicated that we actually reached our debt limit sometime early this month or late in December, and that basically we are paying our bills based upon, I don't want to be harsh here, but we're paying our bills based upon sleight of hand, because we no longer have the ability to borrow any money. And when we already see, as we read the papers and look at the news, that the conversation as to not if, when we will raise the debt ceiling and how we will pay, or if we will pay for that through spending cuts or further tax changes comes into place. The other thing that talks about when kicking the can down the road is the terminology that's used, is the sequestration, which is the automatic reduction in spending cuts. It was supposed to take place January 1st. Basically what Congress said is, no, we're going to make sure that we don't have to do that for another couple months, and gives them more time to talk about it, and we'll be looking to see what happens with that, and that's probably going to happen some in late March. So we really don't know what's going to happen in that area. So my comment here that I've made previously, when I talked about having to remember that we have a different definition in the tax world of the word permanent. So basically, in tax, the definition of permanent is until Congress changes it. And one of the things that many of us are concerned about is that what we may see is Congress may be changing taxes again sometime in February for the debt limit or in March for the sequestration. We'll be watching that. We'll keep track of that. Obviously, it's going to be in the newspapers a lot. We read what Republicans say and what the President says and the Democrats say and everything else. And one of the things that we've learned is not to pay too much attention to what we read in the papers. But something is clearly going to happen in the next 60 and 90 days in this case, so we'll be watching that for you. Again, here's my ugly, along with my direct line, my cell phone number, my office email, and for some reason I didn't put my personal email in there, but you have it in the front, and it's mike@thekoppels.com, TEKOPPELS.com, and you can reach me pretty much all the time. Beloved Tina and I are going away this Thursday. We're going down to Cancun for a week. We won a vacation in an auction. It's going to be away for a week. I will not have telephone access probably, but I will access through my email, and I have Skype so that if something is significant, if you email me, I'll be able to get back to you either through email or through my Skype account and get back to you. And if you email me, I will get back to you within a day or so. So I thank everyone. This is a major situation. It is, with the exception of the loss of the payroll tax holiday, it is almost universally good news. But we'll see what happens as time goes by, whether anything additional changes. You can follow us on Facebook and Twitter and Google and everything else. I strongly advise that if you're not on our blast email list, that you make sure that you contact someone here in the office or contact me, email me, and I'll make sure you get put on our blast email list that we send out, as I do, on a regular basis whenever there is anything really substantive happening, so that basically you can know what is happening and as quickly as possible. Thank you very much. Have a nice day.